Hi there and welcome to the Stockscores Market Minutes for April 23rd, 2012. This week's topic, go away in May. We'll decide whether that is what we should be doing. Before I get into that, I want to just remind you of the Stockscores Canadian Active Trader Expos. Our first event was held in Calgary last weekend, a great success, absolutely full, and lots of good feedback from attendees. The Vancouver morning event is now full, and so we have added an afternoon event. You can register for the PM one, but unfortunately, if you wanted to come in the morning, it is now full. Toronto, May 5th, Montreal, May 6th. For more information and to register, go to stockscores.com/expo. All right, so go away in May. As many of you probably know, there is a traditional slow period in the market from May until October. Index are starting to show some signs of a breakdown, but we still haven't had that decisive breakdown. If we look at a chart of the S&P 500, we can see that the upward trend line, as I have drawn it, which is a bit of a short-term outlook for the upward trend line, was broken today, but the market did not close near its low. In fact, it came back from morning weakness to close up near its high, so it wouldn't be considered a real decisive breakdown in the market, but it is important to note that it was a breakdown from a falling top, and so I would say that we should put the market on high alert right now. So when we talk about go away in May, really the idea here is to always look for confirmation of seasonal tendencies rather than expect that they will happen again simply because it is May. It is May, and normally the market does slow down in May, but until we see that strong signal to sell, it is dangerous to jump in front of that upward trend. The market is trying to break down right now, and I just don't think that the sellers are yet really strong, but certainly it is worth caution. Now, when I look at the charts this week, what I've done rather than take that long-term view is I've gone intraday to look at the very short-term view, and here we can see how the S&P 500 has performed over the last 30 days. Each bar on this chart is a 60-minute bar, and you can see on the open we had that big gap down on word that there was some political issues in Europe, particularly in France, where Sarkozy may not win the election, and that puts a threat to some of the measures that have been made between France and Germany and the rest of the European Union. So we had that gap down on the open, but then the market managed to come back to close pretty near its high of the day. And so, like I said earlier, not a real decisive breakdown. I did a tweet this morning to say, yeah, and in that tweet I said it's time to be bearish if the market closes below its open, and it didn't do that. So I'm still very cautious, but not a full-fledged bear just yet. On the TSX, we have, I would say, a worse looking chart. We had that rising wedge over the last week or two, a breakdown this morning. Market really didn't manage to close near its high of the day like it did in the US, but still some support there, still not a real strong run for the exit door. So again, here I am cautious. I'm slightly bearish, if you want to call it that, but not overly bearish. VXX, which is of course the ETF that tracks the VIX, it, not surprisingly, jumped up on the open this morning, but then faded into the close. And so again, we don't have a real decisive show of fear in the market, at least through the VIX. And so, it's hard to be real bullish on the VIX going higher just yet, although it's really trying hard to reverse that downward trend that has been underway for some time. Money is flowing back into bonds, and we can see on the open this morning that the bond market did rally. For treasuries, of course, up in price, down in yield, and that is a sign that money is looking for safety. But we hit a good high in the first, say, 2 hours of the day and then faded into the close. So it shows us again that there wasn't that real decisive run for the exits in equities. US dollar was strong in the morning, but didn't break its downward trend line on this chart and faded into the close. And so, consistent with the messages of the other charts, we've really not got that strong signal to run away from stocks just yet, although we certainly deserve some caution. Now, if there was big problems in Europe or other places in the world, we would expect gold to rally. It actually fell lower, and that tells me this. It basically is saying that the market doesn't think that Europe is going to fall apart or that there's going to be a big financial breakdown in the world. What it's saying is that, okay, we don't think the the European economy is doing very well, and that's why gold fell lower. Now, gold did come back to close, close to even by the end of the day, and so it does seem like there is some money looking for that safe haven, but once again, I've said it a few times in this video, there really isn't that decisive show of fear in the market. Brent crude is starting to look like it may bottom. It's been sliding lower over the past 2 or 3 weeks. it's tickling its downward trend line on the intraday, and you can see that a rising bottom was formed today. And so we could see oil start to make a comeback here. And you know, if you see that US dollar fall off, that of course will help the oil market. So I would say it's a tough market to call right now. We're really at a critical point. I put a bearish rating on US stocks because I do think it's important to be cautious, but I can't say I'm real eager to go short the market just yet. Canadian stocks have been bearish for a while, and certainly in the commodity space, it's an area to avoid for now, but a lot of these stocks are approaching support, and so we could get a bounce any day now. Gold, I'm neutral. It's right at that upward trend line and needs to bounce off of that upward trend line. And oil, it's showing some signs that it may bounce back from the weakness of the past few weeks, but it really isn't there yet. The sell signals are continuing to show, but none are really strong enough to warrant a run to the exit door. And so I advise trading cautiously and watch for a more decisive breakdown as a cue to short the market. And that could happen tomorrow. I mean, we just have to wait and watch every day, but certainly we can make money from this market going down. If you need a proof of that, go take a look at the chart of the VXX last summer and the gains it made, and of course some of the derivatives of the VXX like HVU on the Toronto Exchange or TVIX on the US exchanges. These are leveraged funds that trade off the VIX, and they had great runs last summer. So if the market does sell off, we have ways to make money from that, and I'll certainly discuss that in my newsletters. Well, once again, there's the Active Trader Expo dates. Of course, Calgary has already passed. Vancouver was full in the morning, and you can now schedule yourself into the afternoon slot. Toronto, May 5th, Montreal, May 6th. For more information, go to stockscores.com/expo. Have a great week in the market and trade well.